Wouter Volckaert, Fund Manager of Henderson Global Trust. Now, it's a bit of an anniversary. You're a year into managing the trust. Has much changed?
Well, quite a few things have changed. We set out a number of goals at the start of the year. So probably let me walk you through the top three. First thing is we wanted to improve performance, and I think we've done that. When I took over a year ago, the 3-year track record was that we were, relative to peers, we were at the bottom of the 4th quartile. Now, over the past year, we're at the top of the 2nd quartile, meaning we've outperformed about 2/3 of our global equity peers. So performance has picked up. Second one is we changed the regional allocation of the fund. One of the first things I wanted to do was increase the weight that we have in North America. I like both the outlook for the US market and the outlook for the US dollar. And I think most important is I found some US stocks that I got really excited about. So we bought things like Western Digital, Dollar General, Crown Holdings, and all in all, we took the US, and Canada, so North America, we took to 55% of the portfolio. Most of that was funded by reducing the UK weight in the portfolio. That went down by about 7%. UK economy is strong. There's many UK stocks that I like, but I wanted to reduce the exposure ahead of the upcoming elections. And then the third thing that we wanted to achieve, and I think we have, is we wanted to increase the conviction in the portfolio. So what we've done is we've reduced the number of names, we've increased the weight that we put in our highest convictions, and we've increased the active share. Now, the active share is the number of stocks and the positions that we have that do not overlap with the benchmark, and that stands at about 85% at the moment.
Now, the trust is overweight large cap names, and these have been a big contributor to performance in 2014. Do you think that outperformance is going to continue?
I think that all depends on the state of the economy. When you look at the stock market, we've come a long way since 2009, and we're seeing some signs of us approaching the end of the market rally. One of them is narrowing market leadership, the fact that large caps have become such a dominant force in the market. Other signs are just the fact that we're 6 years into it, that we're at record highs, that credits and equities are sometimes moving in opposite directions, just to name a few. But on the other hand, the economy, when we look at the economy, it feels like we're just at the start of things, that the economy is just picking up. Credit growth is accelerating. Companies are investing again, companies are hiring again, and employment is coming down. So my view on large caps really depends on my view of the economy. If the economy pulls through, which is my base case, then I think that large caps might start to underperform the rest of the market a bit, because people will focus on the attractiveness of equities as an asset class, and that should come with some better momentum in small and mid-cap companies. On the other hand, if the economy doesn't pull through, then we're likely looking at a more substantial correction in the equity market, and then money will flow further into these large cap equity holdings. Now, my base case is that we will see further economic growth, and therefore I'm holding on to some of these large cap quality names, things that I like, but I'm also starting to pick up some mid cap stocks which are now trading at valuations that I consider to be more attractive.
The trust isn't geared, that's its borrowings. Is this reflective of your outlook, and has it affected performance?
That's true, we're not geared, and it is reflective of the outlook. So my base case is that the economy continues to recover, and therefore I am constructive in my outlook for the coming quarters, for the coming years. On the back of that, I do not have much cash in the portfolio, for example. But 6 years into the market recovery, I do believe that the risk reward isn't sufficiently attractive to put on big leverage, big gearing into the portfolio. So we've got the facilities in place to do so if we would get a recovery, but as long as that's not the case, then we won't have gearing.
Okay, finally, Wouter, there's a bit of a consensus amongst investors that 2015 might be more volatile than markets were in 2014. How do you prepare for this as an investment manager?
Well, I'll start by saying running a trust comes with certain advantages. One of them is I can never be a forced seller. I can't have outflows. And on the back of that, I can take a bit of a longer term investment horizon. And so when volatility comes into the market, you get more sell-offs, and so you get opportunities to buy stocks. And I can just buy them when I think they reach attractive levels and when I think I can make a good return on a 2 to 3 year horizon. I don't have to worry about the stock going down even further over the next month and having to, or being forced to sell the stock at a lower price than I bought it. So I can do what Warren Buffett put so well when he said that I can be greedy when others are fearful, and I can be fearful when others are greedy. So what does it mean in practical terms is I keep this wish list of stocks that I would like to buy if they reach attractive levels. And the nice thing about Henderson is we got a really big global equity team that continue to provide me with new names to put on that wish list. And so what I believe will happen is when we get more volatility in 2015, it will bring me more opportunities to buy attractive stocks at attractive levels.
Wouter Volckaert, thank you.